Hello, and welcome to today's presentation on retirement investing in uncertain times. With the spread of COVID-19, we have definitely entered uncertain times. News stories are breaking every day or even every hour with unsettling details about the virus' impact on health and the financial markets. We understand it can be alarming to see your balance shift drastically through these turbulent times. For those of you that are near retirement, the concern may seem even greater as you look at the changing value of the nest egg you have built from your hard-earned savings. However, the truth is that volatility is normal. Some might say it's even expected. And for many of you, retirement is still in the distant future, and your retirement balances are intended to be invested for the long term. Let's take a look at some examples of market downturns historically. This chart shows bear market declines for approximately the past 70 years. As a reminder, a bear market is typically considered when prices in a market decline by more than 20%, often accompanied by negative investor outlook or widespread pessimism. We have seen significant market declines before, with the tech bubble burst in the early 2000s, as well as the more recent financial crisis from 2007 to 2009. Looking at examples since World War II, the average bear market has resulted in a 31% peak to decline. In green, you'll see this year's downturn highlighted. The S&P saw a 32% decline from February extending into March, but has since recovered somewhat with the year-to-date drop back down to just 20% through the end of March. How drastic has recent market volatility been? Created by the Chicago Board Options Exchange, CBOE, the Volatility Index, or VIX, is a real-time market index that represents the market's expectation of 30-day forward-looking volatility. This graphic shows the VIX level at the highest it has been since the financial crisis in 2008 and 2009. With this level of uncertainty, don't let the short-term ups and downs impact your long-term strategy. It's human nature to act out of emotion rather than logic. Seeing your balance drop is scary, and getting out of the market or moving to a more conservative option may be tempting. Don't let your emotions get the better of you when it comes to financial decisions, especially with the long-term goals of retirement. Try to focus on what you can control rather than the market ups and downs. Let's look at an example of how an emotional investor can let their anxiety get the best of them during market turbulence. Meet Sally. She was 30 years old back in 2007 when she decided to invest at the peak of the housing boom. She takes $1,000 from a savings account and invests it in the stock market. She becomes concerned after the crash in 2008 and puts her funds back into cash. Then in 2010, she decides to reinvest her cash balance back into the market. Note that as the market rebounded, Sally was unable to make up the loss as quickly, and her current balance today is actually less than if she had stayed invested in the stock market throughout. Here's another example of how an investor may be swayed by a turbulent marketplace. Meet Mary. At the start of 2007, Mary is 30 years old. Based on concerns about market conditions, she decides not to invest her money and leaves it in cash, gray line. Mary's twin sister, Nancy, decides to invest in the age-appropriate 2040 target date fund. As you can see in the graph, the investment in cash is less volatile but provides little growth over time, while the target date fund for Nancy results in a balance of nearly 2 times the cash investment. At times like these, we think it's a good idea to get back to the basics. Let's review some solid retirement investing principles that you can build on. First, let's refresh our investment terminology and the investment types. The 2 basic types are stocks and bonds. Stocks are often referred to as equities. When you invest in stock, you own a piece of a company. Bonds are often referred to as fixed income. A bondholder loans money to a company. The company pays interest to the bondholder and pays the face value back at the end of the term. Another important thing to understand before we go into too much detail is the risk spectrum for the different asset classes that you may choose to invest in for retirement. The level of risk flows from left to right. For example, short-term fixed income options typically have lower risk but a lower potential for return. If we look at the other side, international equity may generally be higher risk, but there is a potential for higher returns. Now that we have touched on a few basics, consider these 8 tips to keep your retirement on track. We know investing can be complicated, so stay with us and we'll try to make it simple. 1. Know your strategy and set goals. 2. Determine where you stand right now. 3. Consider diversification. 4. You're in it for the long haul. 5. Avoid market timing. 6. Stay balanced. 7. Remain consistent. 8. Bring in a professional. Know your strategy and goals. In volatile times, it's completely normal to feel uneasy. Developing and maintaining a long-term investment strategy is key to keeping your focus on the end goal, a successful retirement. Don't let your anxiety get the best of you, and make sure your strategy includes time horizon, number of years until you plan to retire, risk tolerance, amount of risk an investor is comfortable taking, goals. What does retirement readiness look like to you? For most of us, the end goal will be to accumulate enough savings for continued income at retirement. When considering your risk tolerance, make sure you include other factors such as the income you are earning from your job, any debt that you have, and other savings you have outside of your retirement account. Putting all of this together will help you decide what type of strategy you want to choose: aggressive, moderate, or conservative. Determine where you stand right now. We encourage you to take a look at the current portfolio selected for your retirement account. Ask yourself some questions. Based on your time horizon, are you comfortable with the risk-return balance? Even with a long time horizon that could warrant a more aggressive strategy, make sure you are comfortable with it. You always have the option to select a more conservative approach if you don't think you can stomach the volatility. Does your mix of stock, bond, and short-term options align with your risk tolerance? Make sure to review your risk tolerance, as this may change over time. This could also change as life events occur, such as marriage or starting a family. These events, rather than market events, are great opportunities to re-evaluate your risk tolerance. Are your expectations realistic? If you have selected an aggressive strategy, understand that there is a level of risk when you have an objective of seeking higher returns. Alternatively, if you have selected a conservative approach, keep in mind the objective of preserving your capital. Another tactic to consider is spreading risk across various types of investments. You may choose to have money in different asset classes, like stocks, bonds, and stable value investments. To potentially offset risk even further, you can even diversify the investments within each asset class. Retirement investing is typically a long voyage, with some people saving for a time period of 30 years or longer. Short-term fluctuations can be alarming, but keep in mind that market volatility is normal. Take the emotion out of investing by not letting short-term concerns outweigh the potential for long-term benefits. In reviewing previous market declines, you'll notice that history is on your side. Even after the worst declines, there have been significant recoveries. Investors who stay the course generally have the value of their investments rebound. The subsequent 12-month returns after major downturns have been very strong, with an average gain of nearly 40%. Looking at the recent financial crisis, represented as 2007 to 2009, the market rebounded over 50%. Don't try to time the market. Instead, focus on time you are invested in the market and the potential long-term benefits. Volatility is very difficult for anyone to predict. It can be very tempting to sell out of stocks amidst a downturn. Rather than trying to time the market and sell or buy at the ideal moment, focus on your time in the market. Just look at the recent volatility as an example. Things can change very quickly. Often the majority of gains, like losses, occur in just a few short periods. Missing even a few of the best days in the market can significantly affect your overall portfolio performance. Another tool that may help minimize market volatility could be rebalancing your portfolio. As time passes, the value of the different investments you have selected can grow more than others. Rebalancing resets everything back to the original mix you chose when considering your risk tolerance. This is an example of what rebalancing looks like. In this illustration, you can see the ratio of stocks to bonds changes over time. Rebalancing back to the original mix keeps you on track with your intended strategy or goals. You may have the option to have your account rebalanced automatically on a periodic basis, or if you prefer, you can always choose to make these adjustments on your own. Alternatively, if you invest in a single fund solution, like a target date fund, which we will touch more on shortly, the asset allocation is automatically rebalanced to targets for you. Some of the best opportunities to buy stocks are often when things seem the worst. Consistent investing and continuing to make contributions through market downturns can offer you a chance to buy stocks when they are at their cheapest, the buy low concept. Consider an automatic plan for investing, such as dollar cost averaging. Let's look closer at dollar cost averaging. This is an additional investment strategy to help combat volatility by dividing an investment into multiple fixed amounts spaced out over a length of time. This removes the effort of trying to invest in stocks at the right time to get the best price. Here's an example. Bob invests a $100 contribution deducted from each of his monthly paychecks to be invested in his 401k plan. Over time, the share price changes, but Bob's investment stays the same. You'll notice that the average price per share he pays through multiple months is $8. This shows that dollar cost averaging can result in a better average price rather than trying to time the purchase. For this strategy to be effective, you must keep investing in new shares through market ups and downs. Still feeling overwhelmed? We hear you. This is your hard-earned money, so you want to make sure you are doing the right thing. You don't have to do this on your own. First, feel free to contact your service provider to discuss your options with a licensed representative. You can also choose to take a hands-off approach and let a professional direct your investments. This may also be accomplished through a single fund solution, such as a target date fund or a target risk fund. Alternatively, many plans offer the option of managed accounts, where you can delegate investment decisions to a professional, typically for a fee. A target date fund, TDF, is a single fund solution commonly offered in many retirement plans and utilized by a large number of investors. The fund is structured to align with objectives to match an anticipated retirement date. Generally, the fund will become more conservative over time as the desired retirement year approaches by adjusting the ratio of equity to fixed income investments. Perhaps you don't have the time, expertise, or motivation to thoroughly track the market in order to monitor your own investment decisions. A target date fund can be a good option. Some of the potential benefits are diversification across multiple asset classes, professionally managed to determine an asset class mix that supports an overall objective, simplicity. You just select the target retirement vintage that aligns with your time horizon, automatic rebalancing. Remember, it's your plan, so make sure you stick with it. Having a strategy and goals in mind may help you keep perspective through the ups and downs of a volatile market. You can do this.